You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In today's industry happenings, we'll offer an update on the growth of ETF option volume. Over the last 10 years, options volume as a whole has grown significantly, but the ETF option volume has really had a spike. If you go back to 2006, yearly option volume at that time was about 2 billion contracts. ETF option volume was about 400 million. Now, since 2006, yearly option volume has more than doubled to about 4.3 billion contracts a year, but ETF option volume has more than quadrupled in that same time frame, growing from about that 400 million contract number I mentioned earlier to over 1.6 billion contracts a year today. ETFs are popular, and options on ETFs are extremely popular. You may want to check out how options are trading on your favorite ETF. That's industry happenings for today.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining me today for Strategy Spotlight is Roma Colwell-Steinke, an instructor at the CBOE Options Institute. Welcome, Roma.
Hi, thank you, Joe. Thanks for having me.
A pleasure. So glad you could make the time to join us today and tell our listeners a little bit about yourself and before we get into some option strategies. So how about if we start there? Tell us a little bit about your background in the industry, some of your experiences, and how you landed up at the Options Institute.
Okay, simple enough. Well, I actually, discovered options in college. So after I had graduated, I decided that I was going to start a career in the security industry, and I moved to San Francisco and started working on the Pacific Stock Exchange. Really didn't take me long to decide that I actually wanted to be a market maker on the floor. So that was in the late 80s. I started trading stock options in 1989. And then 1990, I moved to Chicago and started trading options here. My big product at the time was Nextel. And I traded,
that.
yeah,
Sure.
yeah, it was a really good product. Traded that for 11 years. And then actually moved, we call it upstairs, but moved into our offices to be a risk manager for our group for about 4 years, which was, a really interesting job, but was a job that kind of lent me towards learning how to, manage portfolios, right? Which is what we did. We were managing our traders and managing our whole portfolios. And so sometimes you get in sticky situations and you've got to get out of those trades using different strategies. But on top of that, I did our education. So I taught our market makers how to trade. So when the opportunity actually came to work for the Option Institute a year ago, it was a nice extension of what I had been doing, which is teaching market makers, and now I actually get to teach customers how to trade options. So it's a really rewarding thing to do, but it's an amazing industry. I have a math econ background, which really lends itself for trading options and strategies and, understanding risk that we all take when we put on positions. And, the Option Institute is a great place to kind of teach people, what I know. And I've actually learned a lot even since starting here. So I've met a lot of interesting people of all age groups around the world. And listening to the different products that they're trading and how they trade, and then giving them, more ideas to expand on what they're doing so that they're more profitable. So that's kind of where I come from. And working for the Institute is great. And, just not too long ago, I did an OIC presentation on volatility, and that was a fantastic experience. There was just over 300 people there. And, I got a lot of nice comments about, I never really knew this about trading volatility. So it really opened their eyes, and that was rewarding to hear that, I'm going to help them be a little bit more profitable and understand at least the volatility in our marketplace.
Oh, that is really, that's just a fabulous story, Roma. And, finding your way to the Options Institute just seems like a wonderful, natural next step. And then we're lucky enough to have you, as you mentioned, as an instructor now for OIC. And yeah, I think, your presentation was standing room only. And wasn't it a standing ovation when you were done?
I don't know about that, but they seemed really pleased about it. I mean, I've actually met a couple of guys just kind of randomly since then, and they've all been like, again, I learned so much, and I didn't really understand how volatility worked in the marketplace, but now I have a better idea. And then, of course, managing volatility isn't always easy, especially, if you're buying, just buying or an option, and what are the strategies in case I buy that expensive option. So that was really helpful for them.
Well, we're going to focus a little bit on the ETF space and some of the options growth there. But I promise, as we get into the next year, we'll have you back and we'll spend some time just talking about volatility and Strategy Spotlight, because when we're talking the option space, there's certainly nothing more important. Mm-hmm. So with regards to ETF options, I mean, ETFs have been around since, I guess, maybe the early 90s. Option volume, like is the case with most underlying, started slow, but, started to pick up. We get into the early 2000s. If I reference, say, 2006, I think options volume on ETFs was somewhere in the neighborhood of 350 million contracts a year. Option volume at that time, overall option volume, was about 2 billion contracts a year. So fast forward to 2015 and soon to be 2016, our option volume overall has more than doubled to well over 4 billion contracts a year. I think we'll probably come in around 4.3 billion for 2015. But ETF option volume has more than quadrupled So, we've gone from that 350-ish million contract per year number to we're well over, $1.5 billion, close to $1.6 billion now. So really very, very popular. And that's really what I'd like us to focus on a little bit today, different strategies. And before we do, for our listeners, Roma, are there any key differences between equity options and then options on ETFs?
Yeah, you know what I think. I think the beauty of an ETF is managing your own funds, and we all have 401ks, and a lot of times we have somebody else that's creating those funds. But I think with our own personal money, I personally like buying ETFs as a way to kind of cover the whole market. Now, I do like trading individual stocks. Because there are times when I, walk into an Apple store, or if I, if I'm on Amazon or Facebook, those are products that I use, and I like trading those and investing in those products. But I do like ETFs covering the whole marketplace, because I can't invest in, everything that's out there. So, especially like the four that we're going to talk about. So we have, the SPY, which is our large caps. And if I'm creating a portfolio of these funds, these four kind of make up the whole piece of what I'd like to be invested in. So I have my large caps with, the SPY.
And the SPY, just for our listeners, the SPY is large cap and represents what sector there? Or that's the S&P 500, is that right?
That would be the S&P. That's our large cap stocks. So we're talking more international stocks.
Okay.
That are kind of the overall global piece of investing, which is a really nice part of it. I mean, we live in this global economy, so I think this gives us like kind of a world investment. In some ways, is kind of the way I look at it. Our others are, the Russell, which is our IWMs.
What is that? What does the Russell represent? I mean, I know there are different Russells, 1,000,
right.
2,000.
So this one is the Russell 2000s, and it's the 2,000 small caps, and this is more domestic. So this is covering, what we have in the U.S. And these, top 2,000, small cap stocks. So it's just another, piece for creating this, large portfolio of funds that we want to have for, our investments. And then we have the Qs, which are the NASDAQ. And the nice thing about those is they kind of cover, it's weighted in technology. So we're looking at the more technology piece of it to kind of add to this, well-rounded portfolio that we're all trying to create. And then lastly, we have the Morgan Stanley Emerging Market Index, which I think is a really fascinating index because it, weighs mostly in Asia and then Latin America. So we're kind of creating a nice portfolio using these ETFs. And again, if we want to invest in our more equity-based options, that's just another piece of creating these portfolios. And trading options on these, of course, is a great way to create these portfolios.
Well, that was a real good overview. And I guess when we roll it into options, if we're doing individual companies, obviously if we exercise or get assigned, it's going to be that underlying stock, where with the ETF, you get actually the ETF itself as your underlying. Is that right?
Right, exactly. So we're getting, a pool of assets is what we're getting for when we are assigned on these ETFs. And that's the other, piece of it if we're going to contrast with indexes, right? I think the nice bonus with the ETF is that we do end up with this pool of stocks versus, kind of the cash settlement that we get with the index. So if we get assigned on our ETF, we end up with this, the ownership in this pool of assets, again, building towards this portfolio that we're all trying to create.
All right, very good. So we've got our portfolio, and then we're option users, and maybe there's some of our listeners who aren't. But why don't we roll into the idea of talking some strategies? I mean, when we talk options, I think it's income generation and it's risk management. Why don't we start on the income generation side? What do you like to do with regards to generating income when you use options?
Well, I think the two strategies I like to do, and usually when I start out with following an ETF, and this is the same with my equities, but when I follow these ETFs, I will look at where would I like to buy this ETF. I've been watching the market. I've been watching this particular ETF, and where's my buy point on this? And I love to sell cash secured puts for getting into the marketplace.
Okay, so yeah, when you and I'm sure this is probably where you're going to go. What exactly is that for our new listeners, selling cash secured puts, and how does that work?
Okay, so for our new listeners that are we're looking at cash secured puts, the nice thing about selling a put is that there's two outcomes that could happen. One is if you get to pick where you want to buy your ETF, and you pick that it's basically the strike price, right? So let's look at, for example, if we're going to be looking at IWM right now, so it's trading about $113. I'm thinking about buying IWM. I think buying it at 110 is a good spot to buy it. I'm going to look at the put. If I am assigned on my put, that means that I'm going to have to buy the IWM. So when I'm looking at where I want to get into the marketplace, I'm going to look at my puts. The other side of it is somebody that's going to want to, sell it at a particular price. But the way I look at puts is that where do I want to get into the market? So it's trading
get into the market from the long side. I got
on
you.
On the long side, right. So IWM's trading 113. I'm thinking about getting into the market at 110. I will sell the 110 put for, a premium there. And if it goes down and I'm assigned on my put, I'm long at 110, minus, the premium that I paid for it. But if it never gets there as a way of earning income, if we're looking at income, if it never gets down to 110, then I keep the premium that I sold my put for. So that's kind of how I like to get into the marketplace, is by selling these puts. If it happens to go down there, then I'm now long. In this case, IWM. If it never gets there, I've generated a little bit of income until it does. After I'm assigned and now I'm long this IWM, the next thing I like to do is look at where I might want to get out of this. And I would then turn around and sell the call. And so the nice thing about selling the call against any portfolio is it's a nice way to generate income. And at the same time, I get to select where I want to get out of the marketplace. So if I end up with my IWM at 110, I might say, you know what, I think I've been watching this. A good spot to get out of IWM is at 115. I might sell that 115 call. And if it goes above 115, then I'm assigned on the call. I'm now out of my ETF, and I start all over again. If it never gets to 115, then I collect the premium that I sold my call for. And I've generated a little bit of income in the meantime. And then I'll continue to do this over and over again. And then, eventually when I'm assigned on my call, I would start all over again and look at doing my put to generate some income and actually pick out the place where I wanted to buy this stock or this ETF.
Good explanation. So we start by selling the put. When we sell the put, two potential outcomes. If the underlying is below that strike price, that all-important strike price that you picked where you want to get long, if it's below there at expiration, you get long. And if it's above, you just collect the money. So if you collect the money, you're obviously not going to, if you don't get assigned, you would not sell a call at a higher strike unless you get assigned. Is that correct?
Right. Absolutely.
Okay. All right. So so in and out for income generation. How about is there a particular thought in terms of how much time month-wise? I mean, you do short-term options, medium-term options. Do you pay attention to the levels of option premium? Do those factors come into play with your decision making?
Oh, yeah, absolutely. Now, I prefer short-term options. Most options, the largest decay is going to happen in that last week. So when I'm trading, a lot of times I might go 1 week or 2 weeks out when I'm trading, but not greater than that a lot of times, because I want to just capture that decay that's happening in the last week. And it's easier for me to predict what's going to happen in the next 2 weeks than it is for me to predict what's going to happen 3 or 6 months out. So I generally stay pretty close to where I am now in terms of looking out 2 weeks than I do the further out options. And I've had luck doing that. I mean, I was even looking at these premiums yesterday, and we've got some pretty good premiums. That are even our weeklies that, as of yesterday, that were going to be expiring this Friday. There was some nice premium in there where you could, use the same strategy for, getting in and out of the marketplace.
Well, I think premiums, in the market overall are considerably higher now than they've been in the past, because of some of the things that are going on with regards to the Federal Reserve and things like that. But okay, I think it's important, and this is, why we love to have guests like yourself on. I've had a number of guests who, when they're talking about option selling, they talk a little longer term, more in that 30 to 60 day range versus the shorter term like yourself. But I think that speaks to, your trading background, how closely you watch the market. So, I mean, that's one of the benefits of bringing on lots of different guests. So that's interesting. On the, anything else on the income generation side? I mean, I think you laid that out, very clearly. Anything else there?
No, I mean, not a whole lot. I just recently kind of did this a trade similar to this, and I ended up with some stock, and and so I turned around, and every time I got a nice rally, one of the things I wanted to say, when I got a nice rally, I would sell the call. And, the nice thing about using this strategy is that it's pretty, these marketplaces are relatively liquid. You can, get in and out of them. Sometimes, if I've had an option that's come in and we're looking at the last few days, especially if I'm short, I might buy them in, depending on, what I want to do, or if I'm ready to sell some premium. So I do look at, buying my shorts in so that I can forecast another 2 weeks instead of sometimes waiting until they expire. So that's the other thing I would look at doing if you're looking at these strategies, is just keep track of them. And when you're ready to buy them in and move on to another one, there are plenty of opportunities to buy these options back in.
Excellent. And that's actually another really good point. The vast majority of options, I think it's close to 75% of them, are closed prior to expiration. And, that's what you're talking about. And oftentimes closing something with just a little bit of value left in it to turn around and roll into selling something for a far larger credit can be the right approach. How about if we roll over to the protection side, downside insurance? Are there approaches you'd like to take there?
Yeah. Now, I think one of the nice things also about these protective puts, and this is kind of outside even, looking at these individual ETFs and trading those. If you're looking at your whole portfolio and if you have a portfolio, especially with these ETFs, and your portfolio is under that, $100,000 mark, buying a protective put in an ETF is a great way to protect your investments. And the way I always look at these is to look at the notional value. So when I say that, I will look at where this ETF is trading, and from that, I'm looking at my total portfolio. So let's say I have a portfolio that is worth about $40,000. I would go out into the marketplace and look at possibly doing a SPY. And, if the SPY trades about $200, one call, the notional value of one call is $20,000. So if I'm looking at a portfolio, not one call, but one option is,
Yep.
$20,000 is what I meant to say. So if I'm looking at my portfolio, I know that I have $40,000 worth of risk in there. I'm a little concerned about the marketplace. I would look at buying 2 puts to protect my $40,000. And the nice thing about these ETFs is they're 1/10 of the value. So I couldn't do this in the SPX. Because if I went to the SPX, which is $200,000, right, for one call, I'm going to pay a little bit more for that, or for one put, I'm going to pay a little bit more for that put, versus going to the ETF and doing the SPY, where I can actually kind of manage, my portfolio, which is worth less than the $200,000, and just buy my 2 puts if it's a $40,000 portfolio I have. So there's some really nice benefits to trading these ETFs, considering that they are 1/10 of the SPX or even the Russell index.
And that whole idea of notional value is really important. Gives investors a chance, along with potentially their advisor, to manage how much downside risk they have. So yeah, exactly. And so often the whole option space, investors think, it's so complicated, not going to get involved. I mean, the way you're explaining this makes perfect sense. It's not that complicated. It's just a question of becoming informed and then, really applying your knowledge. So,
yeah. And I think it's so important nowadays that, well, first of all, I think what's important is that, people are educated, that you can create your own portfolios. I mean, using these ETFs is a great way to create your a nice portfolio with your money, but you have to understand the risk that you have in the marketplace. And, the last thing you want is to have your $40,000 or your $80,000 investment, go down, if the marketplace is going down. So these protective puts and understanding, all you have to do is buy 1, 2, 3 puts and you've protected your whole investment. The one thing I was going to say is when you're buying puts, especially, sometimes when you need to buy these puts, you're going to have to pay some volatility for them when the marketplace is rocking and there's a lot of fear or there's some risk, that perceived risk in the marketplace. Options get a little expensive. And one of the things that you can do is offset that put that you bought by possibly selling an out-of-money put. So rolling it into this vertical so that when you're buying this put, right, it's a little less expensive than just buying that put outright. So if you sell that out-of-the-money put where you're kind of saying, I can't see the market going down further than this, but I don't want to get stuck buying this expensive put and having it go out worthless. So so getting on to the next strategy, looking at these bear put verticals is a great way also to, manage your portfolios.
Is there any approach that you like in terms of which strikes to pick when you're talking a vertical put or call spread, but, here vertical put spread?
Yeah, I think that one of the things that I like to look at in part is the premium. So I like to look at, the premium that I'm paying for, the put that I'm buying. But when I'm looking at my downside, I want to see, what does the premium look like for an option that is now $5, $10 out of the money. And, how does that benefit me in terms of what I'm paying for, that initial put? So when I'm looking at them, it depends on, how much movement's going on in the marketplace. If I think that there's, if I have a little bit more risk in the marketplace, if it's really rocking, I might look at a put that's $10 out of the money. If I'm looking at a marketplace where it hasn't been as active, I'm not really that concerned about it going down further. I might look at an option that's $5 out of the money. So it's really kind of based off where do I think the marketplace is right now. If I'm paying a large, premium for this option, it's probably because there's a lot of risk in the marketplace. So I might look at something that's a little bit further out. But it just kind of depends also on, how much premium is in these out-of-the-money puts.
Okay. Makes great sense. Well, Roma, it's been great talking to you. I think great to hear your story. You've got wonderful experiences. We're lucky here at OIC to have you join the team as an OIC instructor. So for you listeners who attend our live seminars and potentially webinars in the future, keep your ears and eyes out for Roma. And we wish you all the best at the Great Options Institute. Anything you'd like to wrap up saying to our listeners?
Well, I would like to add, I think it's really important that we all learn, about options. I think they're the best tool to use as an investment. I personally don't go out into the market and just buy stocks or ETFs or indexes. I always start with an option. So when you're looking at creating these portfolios, there's a lot you can do with trading options to create, some edge, some extra income. So I think that, education is the most important thing. Going to these classes that the OIC offers is a great starting point for anybody out there that's interested in trading options.
Well, Roma, again, thanks so much for your expertise today, and we look forward to talking to you on Strategy Spotlight down the road. Thanks again.
Okay, thank you, Joe.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, we'll focus on the stochastic oscillator as a tool to consider. To start, the word stochastic comes from the Greek word stokos, to aim. In technical analysis, the stochastic oscillator is a momentum indicator developed in the 50s by Dr. George Lane. The oscillator attempts to predict price turning points by comparing the closing price of a security to its recent price range. Usually, a simple moving average is used for the oscillator calculation. The stochastic calculation finds the range between the security's high and low price over a defined period of time. That finding is then expressed as a percentage of the range, which is represented on a scale of between 0 and 100. Some users of the stochastic oscillator look for levels below 20 as an indication a security may be approaching an oversold level, where a level above 80 often represents a security that is nearing an overbought situation. That's a very high-level explanation of how the stochastic oscillator works and what it is. It's a tool that is most often used in conjunction with other forms of technical analysis. Now, I want to point out, levels below 20 and above 80 can continue for a long, long time. So these levels should not be used as abrupt turning point signals for your security. If you like the idea of an indicator like this, I encourage you to check it out more thoroughly. The resource I'd like to bring to your attention is one my colleague, Mike McFarland, introduced to me. It's etfdb.com. That's etfdatabase.com. It's a comprehensive database for ETF information. really comprehensive. The features include the database itself with essential information on your favorite ETFs, including profiles, investment themes, size, price, trading ranges, and far more. Additionally, there are screeners to assist in finding ETFs that you may not even be familiar with, along with performance metrics and industry screeners. ETFDB.com includes a host of free tools, areas of research, along with a free newsletter. Again, that's ETFDB.com. Check it out. Lastly, today's good read is a book by Michael Mullaney, The Complete Guide to Option Strategies, Advanced and Basic Strategies on Stocks, ETFs, Indexes, and Stock Index Futures. It's a large book at 556 pages. Its approach to options education is systematic. In a way, it goes from part 1, which is fundamentals, through part 5, which is more advanced, focusing on topics including volatility. The 5 parts focused on options are then applied to each type of investment instrument mentioned in the title. Consider checking out Mullaney's Complete Guide to Option Strategies. That's today's tools, resources, and good reads.
It's time for a nostalgia break. It's time to take a look back.
Let's take a quick walk down the path of ETF history and options growth in today's looking back. In the late 80s, the first attempt at a structure like an ETF was tried with index participation shares on the S&P 500. There were some issues surrounding these shares, so they really never got going. Then in 1990, the Toronto Stock Exchange tried a participation product. That also really never got going. But then in January of 1993, at the American Stock Exchange, the S&P 500 depository receipt, nicknamed the Spider, was launched. It was popular then and continues to be one of the most actively traded ETFs. There are now a couple thousand different ETFs traded. Options volume on ETFs has grown dramatically with the increased popularity of the ETF product. Over the past 10 years, overall option volume has more than doubled from 2 billion contracts to about 4.3 traded annually. ETF option volume over that same period has more than quadrupled from about 350 million contracts to over 1.5 billion contracts traded annually at this point. Great growth in the underlying ETFs and even greater growth in ETF option volume. That's it for today's Looking Back. Thanks for joining us.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.